So I have a ton of different materials. My goal is really to touch on target date funds for 30 minutes, kind of a combination of maybe 20 minutes of the methodology. So you kind of understand more behind everything from the custom benchmarks and custom peer groups and how we score them to different reports and resources you can utilize within the RPAG system. So I'm going to kind of weave maybe 10 minutes of sales and marketing ideas throughout that. So it's not just kind of, research stuff. And then at the end, Karina on our investment team did a terrific scorecard, like general methodology presentation a few weeks ago. But I'm going to touch on a few just general non-TDF things as well if we have some extra time. So I'll try to be kind of brief with this. But again, thanks for joining, and hopefully this is helpful. So to kind of kick things off here, hopefully you enjoy my very elaborate marketing slides. This is what happens when you do your slides and not your marketing team. So look, here's the challenge when it comes to target date funds and scoring traditionally. If you were to look at Series A or Series B, Series A has a better return over 5-year average annualized return. Let's say this is an average of all vintages, okay? Which one would you say is better for the plan? You kind of understand, given the simplicity of this slide, that it is a trick question. Series A isn't necessarily better than Series B, right? What this is probably just telling you is that over the last 5 years, when our market has been up over this time, that Series A has more equity. So does that mean that it's better? No, it just means that it's positioned differently, has a different demographic in mind, has a different objective, et cetera, right? So it really doesn't tell you much. Let's go to another example. My next slide here is Series C, Series D. So Series C had much better downside protection in 2022 with negative equity markets than Series D. Does that tell you that Series C is better? And it really doesn't. So by the same token, all that's really probably telling you is that Series C had less equity exposure overall, therefore it lost less, right? So you kind of get where we're going with this. Target date funds really aren't directly comparable in terms of their returns. Now, what you can do, perhaps, is line up TDFs with a similar glide path or equity exposure. And I'll run through this in a bit, but what we do is we categorize all glide paths according to their equity exposure. And then you may say, oh, well, if two are moderate, then I can just compare those to each other, right? And the one then with better returns is better overall. But even like slight differences, let's say a 5% difference in terms of average equity throughout, which is pretty slight if you look at the whole universe of glide paths, they differ by as much as like 50% equity. So if a 5% difference in terms of equity exposure, they would definitely fall in the same risk level overall. But think about the difference between stock and bond returns. It's like a 10% average annualized difference right now, right? So it's 50 basis points of disparity between those. That's purely attributable just to the different way the glide paths are designed. So you can kind of see it is very difficult, nearly impossible to compare two series against each other. And by the same token, it's very difficult to compare any TDF to an industry standard benchmark and get meaningful results in terms of, did that TDF do well? It's really just going to come down to, was the market up or down in the observation period you're looking at? For us, it's 5 years. And did that TDF have more or less equity exposure? And if it was more and the market's up, then yeah, the TDF is going to look better. It doesn't tell you much about manager skill. So we're going to this is kind of the background as far as the challenges of target date fund scoring in general. And I'll get into what we do at RPAG to solve for some of this, specifically with the custom benchmarks and stuff you heard about in the meeting invitation. All right, so first, hopefully this view is familiar to you. This is if you were to run a scorecard or a fiduciary investment review for any client, what would typically show up. So I just wanted to run through kind of what you're looking at here, because I know personally from presenting an investment review, there's a lot of things I see, even a lot, like frequently, I mean, that sometimes I just kind of like will glaze over, especially if I don't have a good grasp on something. So therefore I don't go in depth in it with a client, and it's kind of a missed opportunity. And again, potential question that's asked that you're caught flat-footed. So just running it through here, this is American Century, just picked as a random example. The asset class here, that's the glide path risk categorization. We categorize all glide paths as either conservative, moderate, and aggressive. That's not arbitrary, but rather dictated by its risk index. This number, like on its own, doesn't really tell you much. There's different bands there for what constitutes conservative, moderate, or aggressive, but that risk index number determines the risk category. So it is very objective and numerical in nature. What determines that risk index, by the way, is a combination of factors. It's basically the equity throughout the glide path. A lot of it is the equity at retirement, which is a participant's obviously riskiest point, right? When they're no longer going to live off of their income, but live off of this fund. So it's equity at retirement, it's ending equity beyond that, right? 15, 30 years down the line into retirement, what's the equity exposure? It's a little bit of equity at the beginning of the glide path, and then a decent amount actually the slope around retirement. And basically asking how quickly is the glide path transitioning from stocks to bonds. That really is getting at the whole concept of sequencing risk, right? The steeper that is, the quicker that transition, the steeper that is, the greater your sequencing risk and the greater the potential for when the market's going out, or excuse me, when the market is going down and a participant's kind of selling out of stocks into bonds, they're locking in those losses, right? All right, moving on. So there's two ways that we score any asset allocation fund. This actually isn't just target date funds, but so the allocation score or the series funds, that's all the individual vintages. So this is telling you how many of those vintages are there. In this case, it's 10. And then what's the average allocation score of those vintages? So that's what you would see here. Okay. The selection score is basically, think about that as like stock or bond selection, kind of the active component of really getting at what is the strength of those underlying funds. We've always highlighted this. This is something that we actually did before the DOL's tips, where they specifically said plans or fiduciaries should know and understand their underlying investments that make up the targeted funds. This is a level of analysis that is, I think, currently unique to RPAG. We've always kind of done this, but it is a good differentiator because, again, it does follow the DOL tips, and it tells you, the example is in order to have good wine, you need to have good grapes, and we're telling you how good those grapes are. So the number of funds is just how many underlying funds are there in total and what's the average score there. So the blended score, quite simple. It just is a 50% weighting to each of these factors, and that is the blended score that you see, and these are just the quarters rolling back. Of course, it is rounded to the nearest whole number, so just something to keep in mind. All right. And now for each vintage, I'm going to get into kind of the specific methodology a little bit later. This is almost identical to the active methodology that we have, but this allocation score is basically directly attributable to the metrics on the left. Of course, you see 4 points are missing. There's 10 possible total, as you know. So it's an allocation score of 6. Combine that with the selection score, which is really applied to all vintages in the same way. And then you see each kind of vintage blended score as well. So I imagine most of that is review for many of you, but hopefully this is just helpful and gives you a better understanding, especially for those of you who are new. So one thing to note here, I will say there's a smoothing effect that's really generated from the underlying fund score. What I mean by that is like American Century scoring an 8.3, that's pretty typical, actually maybe a little bit above average for an active series. I would say you normally see scores in like the upper 7s to low 8s. So given that, it's kind of like a built-in boost in a way. And the reason that I'm mentioning this is it's going to be very rare for a target date fund series to be on watch or to be up for removal. In other words, you're really rarely going to see the blended scores below a 7. That would be watch list. And as you know, a fund has to be watch listed for 4 consecutive quarters or 5 out of 8 to be up for removal. So I just say that because when it comes to existing clients and ongoing due diligence, I wouldn't necessarily wait for a series to be up for removal before making a change. What should really probably drive existing client changes should be fit in demographics, right? So if you just wait for kind of the scorecard to tell you what to do, again, for targeted funds, it's likely to never be flagged and up for removal. So I say that fit is kind of a good driver or trigger and thing to emphasize, and I'll pull up something here. So hopefully most of you are familiar with our fit analysis. It's a tool that's in our TDF analyzer. Our team can actually run these reports for you if you prefer to outsource it. But this is basically asking the question, okay, well, hey, American Century we saw was moderate. We see that there's all these glide paths here, right? What's best for my demographic or this particular plan's demographic, I should say, right? This is really important, getting the fit right, because the risk level has a huge impact on the returns, as you would expect, right? The returns of that series. So for example, around 2008, during the GFC, aggressive target date funds, as categorized per our system, lost double the amount of conservative target date funds, with a drawdown of up to 51% for the retirement vintage, while conservative, some of them only lost 10%, right? We've seen this example before, but this is why it's so important to get this right. And what this really comes down to, and what the DOL stresses in their tips 8 times, they mentioned this 8 times. What's the risk level of the TDF? How risky is it? And does that match the participant characteristics for that plan? We love focusing on fees. You know, we make that very clear and apparent. We all know that's an important role of an investment advisor, right? We know that performance is important, right? Our whole scorecard is predicated around that, basically. But the focus of the DOL tips, and frankly, again, given kind of the unique methodology that we have for scoring, what a lot of your due diligence should be predicated around is that concept of fit. And frankly, again, getting into marketing and sales a little bit, it's an angle that not many advisors are taking, and that you can immediately differentiate yourself, because everyone's going in saying, hey, you can knock off 1 bit by moving to this passive series that just lower their fees. Everyone's kind of doing that. And everyone's going to the same, recommending the same series that have the highest performance, which, as we had just talked about, really doesn't tell you much about the strength or skill of the manager of that series, right? It's going to be driven primarily based on that glide path. So hopefully you've seen the fit. This is a plan level questionnaire that's really simple to fill out. And the idea here is an aim before you shoot exercise. Hey, for this demographic in particular, based on their contribution rates, based on their account balances, their investment knowledge, their engagement, et cetera, what is the best glide path or risk category for this workforce overall? In this case, 2 conservative, 1 moderate recommendations. The system's going to recommend you look at conservative glide path. In the end, what does this do? Yes, it follows the DOL tips. So from a fiduciary liability standpoint, it's terrific. Again, the sales and marketing angle, it's something that's different. It also just factually leads to better outcomes. It does. If you have a risk averse group that's going to sell out after periods of volatility, you probably saw this a lot last year. A lot of people calling, asking questions. Oh my God, I need to move cash. People can't withstand that risk. They're going to bail out of the TDF. TDF's #1 asset class, or asset class with the #1 most amount of outflows last year. These aren't really set it, forget it participants as much as we would like them to be. They can be reactionary at the worst possible time. So you need to look at those things like involvement and risk aversion to get this right, or else they're going to move to cash. They're going to stop saving. That has detrimental impact. So this is an example of why this is so important, and how this actually leads to better outcomes, right? Think about this from a need to take risk standpoint, where I was touching on it from a willingness to take risk standpoint in terms of risk aversion and engagement. But think about like funding for a pension plan, where a well-funded plan, you just wouldn't take on a crazy amount of risk because it introduces too much uncertainty, and you're factually gonna deteriorate outcomes, right? Or vice versa. If a plan is underfunded, you just wouldn't have a ton in fixed income and go full LDI because you need to make up for your funding shortfall in the end, right? So we can take the same approach with the DC plan and with the TDFs, and looking at contribution rates and account balances, et cetera, to see how much risk does the plan need. And we're going to take on that much risk, but no more, right? So that's kind of some of the benefits of the fit. And again, some of those quips you can use with prospects. You can reinforce the importance to clients and constantly sell them on how you're different and forward thinking in terms of how you look at things. You can't compare series to series, but you also can't compare a series to a common industry benchmark for the reasons that we talked about, right? So what RPAG does to give you a better idea of manager or TDF skill is that each fund gets its own custom benchmark. So the custom benchmark, literally every fund, okay, every asset allocation fund, a 2035 is different than a 2030 in the same series. An American Century 2035 custom benchmark is different than, you know, the Putnam 2035 or T Rowe 2035, or even another moderately categorized TDF. And the custom benchmark is just derived from the actual fund's return. It's basically the exact portfolio that that target date fund has, just kind of watered down and simplified or handicapped to 4 broad-based indices that you would expect to see with every target date fund. So those asset classes are cash, US fixed income, US equity, and international equity, very core, broad-based, bare bones asset classes, right? And so that is the custom benchmark. So what this fund is getting compared to is a custom benchmark comprised of 9% cash, 26% US fixed, 46% US equity, and 18% international equity. Okay, so it's a very, very close kind of approximation or resemblance of the actual fund. Now, you may be asking, well, if the custom benchmark is based on the actual fund, then how is the fund any different? How can it out or underperform the custom benchmark? So there's really 2 ways. Is think about tilts and decisions within these asset classes. So this is US equity, the Russell 3000 index. There's 46% weight there. So if American Century has added alpha through active management and stock selection, right? They've picked better or, you know, funds that, or excuse me, stocks that have outperformed, then they're going to do better than the Russell 3000 because that's the index, right? So it's stock selection. It can be tilts. So if they've tilted to be more growth than value over the last 5 years, growth has outperformed value, so they're going to look better, right? But the biggest driver is going to be asset classes outside of these 4. So almost every TDF, especially active TDFs, have asset class exposure beyond this, right? So emerging markets, REIT, commodities, tips, high yield, international fixed income, right? All of those are really not going to be in that custom benchmark, right? So any of those exposures are going to cause, take like, I guess an easy example would be like take high yield, right? So if the fund has high yield, then it's going to be obviously influencing its return. Now, what the custom benchmark is probably going to do is pick the majority of that up as like normal fixed income, but high yield kind of behaves a little bit like equity as well. So I would just guess that some of that is going to be picked up as equity too, right? So in the end, that manager's decision to include that is going to either help it from a risk return standpoint or hurt it. And that's what essentially the metrics are going to show you. So hopefully that's helpful in terms of how the custom benchmarks work. Just real quick, I said that I would give a comparison to the active methodology. I mean, if you just give this a quick look, everything is the same between asset allocation and active. Risk level is just a gimme point, by the way. I guess I'll just kind of run through this real quick. Risk level is a gimme point. Like asset allocation fund's never going to fail this unless they have like 0% equity or like a crazy amount of standard deviation or very, very low standard deviation. They're basically cash. It's a gimme point. Style diversity, by the way, is basically looking at, hey, for this asset class category, this fund falls in the moderate. That's another thing that I should probably touch on is we're not talking about glide path, the whole series kind of categorization like we did here. That's the whole glide path on average, right? As determined by the risk index. But each individual asset allocation fund has a asset class, and that's not like, hey, this is the 2035 asset class. It's actually based on its risk level, its 5-year annualized standard deviation. So here are the asset classes for any asset allocation fund. So this is conservative, moderate aggressive, and aggressive. And these are kind of the areas that I mentioned where the fund would fail that first point. So this one's in this middle band, that's moderate. What style diversity tells you is, well, what are the acceptable kind of ranges for these different broad-based asset classes for a moderate fund? So like you might see a fund that has too high of cash exposure and it fails, for example. You can see this one's actually pretty close at 9.5. So if that was 10.1, for example, then it would fail the style diversity metric. Let's get back to this, R squared. There's just correlation. So all of these exactly line up. The one difference would be Sharpe ratio versus info ratio. It's basically just looking at, that's for the peer rank metric, just looking at kind of risk adjusted return, right? So asset allocation versus active is almost identical in terms of its methodology, both a 5-year window. The difference is active just uses common benchmarks. Like if it's a large cap blend fund, you're getting compared against the Russell 1000 blend, right? Whereas, as discussed, asset allocation funds use a custom benchmark. So it's really unique to each fund. So that's really the biggest difference, and kind of why they're separated. You wouldn't think that we need like a different methodology, but it's really more to do with the custom benchmarks. All right, so one thing to note, look, this is a great system because of that fact that it kind of has that neutralizing factor, and it is specific to each fund. The one thing that I would just say as kind of a caveat is we're looking at a 5-year window, and you kind of have to, you start extending the time horizon, and honestly, just a lot of funds don't score, and it makes your life tougher because more doesn't score. But think about target date funds are a 20 to 40 year vehicle, and a lot of the decisions that asset managers make with their glide path are designed to be 20 to 40, have a value over 20 to 40 years. And so a good example of this, and something that like might hinder an asset allocation fund versus its custom benchmark in the 5-year window, but that's not necessarily like a bad thing. Or I don't know if I would say it's not a bad thing, but it just didn't have the opportunity within that period to show its value, I should say. Think about commodities. So for so long, we were in a low inflation, no inflation environment, and commodities is a sleeve in most active target date funds because it's a diversifier to core asset classes. It doesn't really have, it has lower negative correlation versus stocks and bonds, right? So the volatility reducing impact benefit. And mainly it's the best inflation hedge, which is why it was like the best performing asset class last year, right? So for a while, series with commodities got docked, right? Because that exposure probably got picked up as equity in the custom benchmark, and equity crushed commodities in terms of return for the longest time, right? So that caused maybe some funds to fail these risk return metrics, right, for some time, when really like conceptually commodities made a lot of sense. And then you give it enough time in 2022, it added a tremendous amount of value, right? So it's just one thing. Like real estate is one that right now, a sleeve in real estate, like in the CFA Institute, you're literally taught that it has beneficial impacts to portfolios, right? It's a growth asset just like equity. And in the long run, it has low or no correlation to stocks and bonds. So like makes a ton of sense to have real estate. Well, right now, just real estate in a 5-year period isn't doing that well. So a series with it might fail some of these metrics. The risk return points, by the way, I should clarify, those are the ones that are really like risk return and risk adjusted return for the asset allocation funds versus its custom benchmark. The peer ones are obviously not versus the benchmark, but versus peers, as you've probably surmised. So anyway, it's just one thing to keep in mind as far as like the value of certain asset classes and how over the 5-year window, and thus the score you see, the value may not surface. And so really, how do you kind of factor that in? You're not going to want to hear this, but in my kind of interpretation and opinion, most of target date fund analysis should really be qualitative. We're not paying the electricity bill. There we go. So most of it should be qualitative. What do I mean by that? Well, instead of like, the score is the starting point, right? So thinking about that real estate example, do you conceptually agree with that or not? And you don't necessarily have to, but if you do, then you should be okay with the series, or in a way prefer maybe that they fail the risk return metrics, right? It just hasn't had the opportunity in the 5-year short window of this 20 to 40 year vehicle to show value, whereas it has in the past, and it's likely to in the future, right? One thing that can help with this, especially in terms of asset class exposure, is in our TDF analyzer tool. In our comparisons, we have this chart that shows asset class exposure. This is a new kind of output and visual. which shows you for all these various asset classes, is the asset class exposure derived through a dedicated fund position? In other words, a fund that just covers that asset class. Or is it achieved indirectly through a fund in another category? So maybe it's like a SMID cap fund, right? That would indirectly cover mid and small, or in this case, the mid cap exposure for FlexPath is derived through a combination of the large and small cap funds, right? So it's kind of cool, and it tells you obviously where there are gaps. Hey, this fund doesn't have REITs and commodities. Like, I like that. I like something with more asset classes. So more diversification. So I'd want that, right? So this can be informative about a series. The one thing that I would say is more asset classes isn't always better. And this is kind of a knock specifically on JP Morgan Compass tool. Look, it's a great tool. There's a lot of tools out there that are quite helpful, but having just more asset classes isn't necessarily better. You need to think about what is that asset class specifically contributing. Like high yield is one where the asset class may make sense, but you may be better off, especially in the TDF, taking that risk on through equity exposure, right? International bonds, right? With the currency risk that's introduced there, transaction, hedging costs, et cetera. How much actual additional diversification are you getting from international bonds? That's just a question that you kind of need to ask yourself, right? So, and maybe more than anything, I would say would be breaking down the glide path shape. So this is something that can be subjective, qualitative, that you should think about and not just rely on our categorization, which is, again, helpful and a starting point, but just think about some like logical things and how, what's not just what you feel is best and what makes logical, intuitive financial sense, but also, again, what's best for that particular workforce and demographic. Do you want a series that starts out that leaves 10% growth potential or equity exposure on the table for younger individuals? They might say, hey, that reduces risk for those individuals. So, it's important to keep them invested. You should look at, how much does that actually reduce risk and how risk averse are younger individuals? What we see is they really aren't that risk averse. So, starting equity exposure at the front end of the glide path, to versus through, is something we really don't emphasize. I think it's way more important to understand where is that to versus through on the risk spectrum and what's the equity exposure. Because you could have a 2 with 50% equity, you could have a 2 with 20% equity, you could have a through with 56% equity, you could have a through with 20% equity exposure, right? So it's more important to know the overall risk level, but this is a conceptual thing that you should really answer. And by the way, the right answer to that question is not, are people staying in the plan or pulling their money out of the plan? Twos are not designed for people that leave at retirement. No asset manager is as lazy as just saying, well, I'm sure people pull it out, so we're just gonna leave it flat and just stop managing it. It's designed to be a lifelong distribution vehicle and sustain a lifelong distributions and spending. The rationale for most two managers is just, look, that's your financially riskiest day. You need to make that money last the longest time, right? So your potential for losses is at its highest point. And so you should really be at your most conservative point there. Do you agree with that or not? I think you just need to look into that, and that should be a small factor in your decision. But again, these are just a few examples of kind of qualitative in the research and going beyond just the score. All right. So a few other things, kind of getting away from the methodology, but other resources that you can utilize that I think are tremendously helpful. The first is what we call our snapshot. I want to find another one. I mean, this will do. So I want to make it not so FlexPathy, but this is a terrific way in one slide and visual to get both sides of the ledger for a TDF. So I'm going to actually remove FlexPath here. Start. So here's the challenge of, if you look at first of all, returns analysis doesn't tell you anything about the risk, right? So naturally a flaw right there. Okay, now if you, I don't think I have the version. We have a version that shows return and risk, and think about all the different time periods. You have quarter, year to date, 1, 3, 5 since inception, all those time periods. You're going to look at different series, compare them to each other, maybe a benchmark, right? So now you have even more data points, then you have risk and returns, a ton on like 2 to 3 different pages. You can't absorb all that. No one can. And for you to explain that to a client is just an absolute nightmare. So the snapshots are really cool because what it does is it averages all the vintages. It does it over usually like a since common inception time period or a 5-year time period, right? And through one visual, you and a client can understand the risk profile and the proficiency of a series. So you really get upside metrics on the left, up capture and return, downside metrics on the right, down capture and risk. So you can immediately see for John Hancock multi-manager, okay, first of all, I would glean this is probably an aggressive TDF. Does that check out? Yes, they're aggressive. Why do I say that? Well, you know, their up capture and their return is higher, but also their down capture and the risk is higher than the peer average, right? So it tells you like, look, their returns are fine. Like they're doing better than the peer average TDF. That is probably generated. I mean, you see it's generated from having higher risk than the peer average TDF as well, right? So the question is then, and this is why it all comes back to suitability, is this right for the plan, right? This doesn't mean that this doesn't mean that they're doing a better job or like are the best TDF because they're outperforming peers. This doesn't mean that they're worse because they're taking on more risk, right? It comes back to, is this right? Can participants withstand this volatility? Do they need this much risk based on their savings rates, right? So if they're risk averse, if they have really high savings rates, they probably don't need this much risk. You can afford to de-risk, right? And this is where, when you look at like throw in a moderate or a conservative, and you're going to see the exact opposite. You're going to see better than peer down capture and risk that's lower, but you're going to see returns that kind of take a corresponding hit, right? Now, this is where it is kind of an unfair and deliberately apples and oranges comparison with FlexPath, because the bottom line is like, look, you're going to have different types of investors. We're trying to capture the average, right? And like the examples I was just going through are, you know, are most participants risk averse, right? Are most on track for retirement in terms of their savings? But we all know there's going to be both of these types of investors. Those that need aggressive, want aggressive, need conservative, want conservative in every plan. And that's where you can see like, oh, well, for aggressive FlexPath, yeah, it has basically the same returns as John Hancock. So those investors that need or want that are going to have their objectives fulfilled. Right now, there's just a huge gap for those participants that need or want conservative. They can't get that out of the TDF currently. So where do they go? They go to the core lineup. They fumble with that decision. They get worse returns. They start, you know, trying to market time and do all that, or they call you, and frankly, you can walk them through this in 30 to 60 minutes. But to do that for every participant is just a huge burden on your shoulders and time suck, right? But we want to help people in this through a risk-based glide path approach. Frankly, it could be through managed accounts. It could be through a risk-based series. There's other ways of solving this. It could be through DRM, dynamic or dual QDIA, right? But allowing participants to fulfill their unique objectives is something that's tremendously benefit, and that you're going to see no matter what with one glide path you really can't do. So speaking more to this point, kind of getting to more the trend of personalization, there's just a few things that I wanted to hit on. First, more from a tool standpoint, is our misfit risk calculator. So this is basically a different way of doing suitability that's a little bit scaled back and easier, and you're only looking at savings rates. This is tremendously impactful because savings rates are really the biggest driver of funded status and success for a participant, right? So what you do, you could choose, okay, the current glide path is aggressive. Let's say there's 6 million in TDF assets. And then you're just plotting out, where are people saving? How many people are saving less than 6%? You know, we'll keep it at 70. How many people are saving between 6 and 12%? You get it, right? So in the end, this is telling you the current glide path, which we said is aggressive, is a good fit for 48% of participants, right? So first things first, your best fit's aggressive based on that, right? That's the peak of participants. So this is the best glide path for the plan overall, right? And if it was something else, let's say that the current glide path was moderate, you would see, hey, well, aggressive is the best fit. What we basically use here is math from like a Morningstar white paper. that uses just some crazy math that tells you how much better when people get in the right allocation and the right glide path. As I mentioned before, you're improving their probability of success and their outcome. How much value are you really adding? And so this kind of quantifies what the value is of moving from moderate to aggressive in 1 year over 5 years. Taking that a step further, let's go back saying this was aggressive in our original example. So you might go to an existing client and say, hey, you know, where we're in today with the aggressive glide path is the best fit. So we don't need to do anything. I would encourage you to take it a step further and say, well, look, we do have 52% misfit risk. So actually, we're only covering a minority of participants. And there's a lot of people, the majority, that need less risk. Now, we can't just like move to a moderate because we're helping less than we're hurting, right? So this is where a conversation, when you see a high degree of misfit risk around something that's more personalized, can really add a lot of value. And we quantify what that value is. Hey, when you're removing misfit risk for everyone, what is the value here in 1 year? And cumulative will be over 5 years. So it's a cool tool. It's simple to do. You really only need savings rates. We are a huge fan of the red flag sales training program and process. And the whole idea behind that is you're quantifying the cost, consequences, and risks of specifically prospects not taking actions, but you can kind of do it from a client standpoint too. Hey, we're quantifying the benefit here if you move to something that gives participant level suitability. And that's something that, you know, you're not charging them $3,800 for this benefit, but you're adding that much value. So you're reinforcing the value that you're adding, and you're putting a number behind that, which is certainly cool. So that's misfit risk calculator. This kind of brings up something else I wanted to touch on, which is, and I mentioned kind of all the different options that are out there in terms of solutions that offer personalization. This is a great resource that we developed, and this is actually a byproduct of our 2022 conference presentation. So you have all these different options in terms of QDIA, right? The whole industry, like the majority of everyone's attention is on this, and it's one of many different options. And frankly, there's more. I mentioned dual QDIA. You could like put that on here as well. Everyone's graduated beyond a balanced fund. The industry's really moved beyond risk-based series. Vintage blending is brand new as of this year. Risk-based TDFs is FlexPath. Managed accounts is getting more and more attention. But single glide path TDFs today is like by far the favorite, or I should just say the most heavily utilized as the QDIA. In your competitors, this is what the majority are talking about, right? And everything we've talked about up to this point has been TDF methodology. What's best practices in terms of TDFs? How does RPAG view it? What does the DOL say as far as TDF tips? It's all in this, area, right? Instead of, we call this like blue ocean. Instead of trying to differentiate what you do that everyone else does, TDF analysis, and we've tried to give you, like different ways of doing that instead of just fees and performance, because everyone's doing that. Let's find something that's lower cost and higher performance. It's just going to lead to a vicious circle of like, constantly changing the TDF, constantly leaving the door open to someone else saying, oh, well, you moved that advisor because they recommended a better TDF, better performing TDF. Well, I have one that's even better. And it's just like not that productive for the plan. And it's not great for you from a retention standpoint, right? So the suitability angle is something that is unique, kind of blue ocean within TDFs. What's really blue ocean is QDIA analysis and QDIA selection. So, hey, I'm sure you've looked at TDFs, that's terrific. Are you sure that TDFs are the right QDIA for you? Because there's all these other options. Have you heard of vintage blending? Have you taken a look at managed accounts? We have access to a risk-based targeted fund that's more flexible, right? So helping a client navigate this spectrum and walking through the pros and cons, which is exactly what this deck does, going, item by item for each of these different options, walking through kind of the pros, cons, et cetera, is something that's an extremely valuable service for an existing client. And it's honestly, it's fun. It's a different discussion, and it's really important because, again, obviously a lot of assets are in the default. And for a prospect is a home run. So happy to kind of pass out these slides. Again, this is basically our conference presentation last year. I think you should be able to actually go through and watch that if you wanted to. You could download the slides as well, or we're happy to have a conversation with you about this. One thing I would say is this is just like a few slides. There's a longer version that works in like TDF basics. What else? Like TDF suitability, participant behavior, some stuff from 2022 in terms of behavior and performance. That is a terrific seminar and webinar deck that has been great for obviously like a prospecting event you're doing, just value add if you do like a monthly or quarterly webinar or event for whether it's clients or prospects or both. It's an awesome one. It gets a good draw, good engagement. And again, you're just changing the conversation. People are going to be interested because TDFs are so important, but then you're kind of changing the discussion as well and showing, hey, where's the industry going? What else can we be looking at here? That reminds me of one last thing before I sign off, I think, which is our team is doing monthly, what we call TD briefs. So it's meant to be, it's not really a podcast, it's just a Zoom just like this, but they're like 5 to 10 minute videos where we pick a topic. It's usually target date fund related because there's so much there and we touch on it. So like walking through all the different personalization or ways of personalizing the QDIA is one of the topics. Participant behavior in 2022 and like the outflow metrics that I mentioned is one of the topics. The scorecard methodology and what I did for the first 15 minutes was one of the topics. So stay tuned and keep an eye out for those. I think they're kind of fun. Throw it on in the car when you're on the treadmill, you know, entertain your spouse when you're drinking a beer or bourbon at night and have them learn about target date funds. No, I'm kidding. Don't do that. I don't want to be a cause of consternation at your house. But hopefully it's fun, it's easy, it's ongoing education, and it's much shorter than, frankly, even this like 45 minutes we've already spent. And we keep it kind of fun and interesting. So keep an eye out for those TD briefs. Last thing, if you're just here for the TDFs, obviously at any point, feel free to sign off. But I did just want to go back to the scorecard in general and give you tips that aren't target date fund related and things that I've kind of learned over time, since we do have some extra time. So it's really just a few things. I'm sure you know well kind of the active, the passive methodology, but just some things that I've kind of learned over the years. I forget at some point, and then like a year later, I'll come across it again and I'll remember. So do you guys know what these style points are? Just look like random numbers. So this first one is basically your horizontal axis positioning. So this is a large blend fund. So if you look down here at style analysis explained, this is 0, like a perfect blend. This is 100, a perfect growth. This is negative 100, a perfect value. So you see negative 44, that's almost a perfect blend with a very, very slight value tilt. And that's what you see. The square there is just to the left of it, right? 94. So the bottom number is basically your vertical axis positioning, where 100 is perfect large, negative 100 is perfect small, and 0 is in the middle, obviously. So you see 94, yes, this is a large cap fund. And of course it has a little bit of like mid or small cap exposure. Where and why that's helpful is in particular with like a large value or growth fund, with such a big delta right now between value and growth, you can get an understanding of like, oh, take like AB large growth, it has a quality bias, right? You're going to see it not necessarily plot out all the way to the right side. So you can kind of see, you know, get a little bit of an understanding of its overall like discipline within growth, and also give you attribution like, oh, well, naturally a series that's positioned that way with growth outperforming over the 5-year period is going to, you're going to expect it to slightly lag versus like a strong high octane pure growth strategy, right? So something that can be helpful, especially again, like someone asks you a question on the fly, that's something that you might be able to answer right away and infer some things about the strategy that again, inform you about the numbers. It's all about understanding what's driving the numbers, not just regurgitating what the numbers are. When risk return fails, so quick thing here, risk, this is your 5-year annualized risk, your standard deviation, and this is your 5-year average annualized return. So a lot of people say, oh, the score doesn't show returns. It does. It shows your 5-year return right here. So it's a quick trick, and you don't necessarily need a returns analysis to see what the returns are, at least over 5 years. So it's impossible to, if this, just from looking at these, to know or really understand if a fund is going to pass or fail the risk return metric. most of you probably know this, but the only way that a fund fails is if it takes on more risk than the benchmark and it returns less. So think about it. Ideally, you take on less risk and return more. You're going to pass, of course. If you take on more risk and you have more return, fund's also going to pass. If you take on less risk and less return, that's okay. Fund's going to pass it. Again, the only way it fails is if it takes on more risk and has less return. Okay. Info ratio is one that's, I think, kind of commonly misunderstood. Info ratio passes if it's positive. So basically, like the formula for info ratio is excess return over tracking error, or really excess return over the volatility or the standard deviation of that excess return. So you could think about this as risk adjusted return, which is like kind of true, but it's really looking at the consistency. It's looking at the really the volatility of that outperformance. So in other words, the number is going to be positive if the fund outperforms. The number is going to be negative if the fund underperforms. It's that simple. The benchmark, of course. But basically, how consistent is that outperformance? Is it kind of consistently outperforming by, 20 basis points, 20 basis points, 20 basis points, 25 basis points, 15 basis points, month over month kind of thing? Or is it like insanely better performance in one month and the next month it actually underperformed the benchmark, and then the next month? So if you have wild swings of that outperformance, then the info ratio is going to be diluted. Whereas the greater the consistency of that outperformance, that info ratio is going to be higher. So that is the tiebreaker, by the way. If you look at our system and you see a bunch of 10s, the tiebreaker and what's going to determine the ranking or order of that is the info ratio. So it's a really cool metric that frankly not a lot of people, like plan sponsors, know or understand or frankly care about. But that is kind of how I explain it, is just like, well, look, if it's positive, it's outperforming, and that's fine. But what it's really doing is measuring the consistency of that outperformance. Last thing would be our peer ranks. So our peer ranks, the way that we do them in the methodology, this is something that I probably should have started with because I think it's really cool, and it is a differentiator versus competitors. So this is a chart from our asset class review, or a short asset class review. So the way that we do peer ranks isn't like a point in time peer rank. What I mean by that is, look at like this Putnam large value CIT versus ABC company fund. If you look, ABC outperforms over every period, basically quarter, year, 1, 3, 5, over the 10, it's finally even, but this is out of the observation period, right? So while looking at performance, you might want ABC company fund. This is a look at their rolling peer rank comparison. So you can see each of these data points is a point in time 5-year peer rank, by the way. So you can see ABC has a higher point in time 5-year peer rank than Putnam because its performance is better, right? Now, this is the 5-year peer rank as of a quarter ago. And yes, this is quite dated. A quarter ago. So it keeps rolling, right? And so what the peer rank number is that you see is a median of these observations. So in other words, there's 11 data points here. Throw out the highest, or I don't know if there's 11 for the ones that we use. You throw out the highest 5. Here, I'll just show you what it is for the TDF. This is actually the one. So each of these is actually a 3-year. This is the 5-year rolling, right? A lot more observations. And this is actually a 10-year period because this is March 2018. Each of these points is a 5-year number that takes you back to 13. That's a 10-year really window you're looking at. So this is actually what determines the metric. So each of these are 3-year point in time ranks going back to 2 years ago. And so 2 years ago, this is a 3-year number. That's the 5-year observation period. So what this really does, there are now 11 observations, or excuse me, there's 9, sorry. So what you're doing is you're throwing out the 4 highest observations, take you back to stats class. You're throwing out the lowest 4 observations, and what's left, the one in the middle, is your median. So that is the number that you see that is your median rank. That's the peer rank that you're going to see. So why is this important? Let's go back to this example. In this case, like the majority of outperformance was driven by one really good quarter, right? So this fund was sitting in the bottom half of the peer group for so long. So it had one great quarter, and that's going to it would have a huge impact on its point in time peer rank. As you see, its point in time peer rank went from like 55th percentile to 5th, right? You don't want that, because you don't want a fund with low consistency. Like, it's going to have a high change in score, so you're going to have to constantly be changing funds, going through the administrative hassle. It's going to create concern on the part of the participant, right? It's going to induce that kind of panic selling behavior that we talked about that frequently happens. So you want a fund that's more consistent, and the way that we do our peer ranks gives you a better indicator of central tendency. This is a fancier way of saying it gives you a better indicator of consistency in the long run. What's cool is I don't have it up here, but this is in 2020. You fast forward in 2021, Putnam outperformed by like 9%. In 2022, Putnam outperformed this fund by like 5 or 6%. So the scorecard works. Having a fund, targeting a fund that has better consistency works. And that's one thing that's unique with our scorecard. All right, everyone, that's what I have, all that I have. Really appreciate you making it this long and tuning in. Happy to answer any questions that you have. So feel free to write into either the support line or me directly, and look forward to touching base with you soon. Thank you all.